What's up everyone, it's Scotty with MoneyVest. So in this video, I wanted to talk a little bit about the real estate market and the housing situation over in the US, considering that interest rates and mortgage rates are now hitting their highest levels in over a decade at over 6, 7, 8%. And it's becoming increasingly more difficult for borrowers, for buyers to basically finance the purchase of their new home, while the sellers are sitting on a very, very low rate and they're locked in 2%, 3%, 4%. Anything that's under 4 or 5% is what they're sitting on. So this has been the widest disparity between buyers and sellers in this current market environment. And that's exactly what I wanted to go over. As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. A link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the buy and sell alerts, options alerts, trade ideas. Everything's going to be included, as well as the stock reports, our members only private videos, and our trading view charts, and the early access to our beta launch for the MoneyVest Pro platform in early 2024 as well. So again, links are going to be down below. There is a 16% annual discount that you can access, and we'll love to have you on board. So this right here is the report that came out today. So it's a tale of two housing markets with buyers and sellers at opposite ends. This from Fannie Mae. And it's a tale of two markets where homeowners are in good shape because they probably have a lot of equity in their homes because prices have continued to increase, and they probably have a mortgage that's 2, 3, 4%. And they've got that lock-in effect of not giving up that mortgage. And, we discussed this in one of our previous live streams as well. I specifically mentioned that that's what's going on right now. We've got homeowners that are sitting on a very, very low interest rates because mortgage rates have not really gone up to these levels in over several years, right? I mean, we haven't seen mortgage rates. So if you come over to the yield chart here, so over here, let's just reload this, but mortgage rates at 7, 8, 9% for 30-year, 15-year fixed hasn't been at these levels since 07, 08, I think last time I checked. So if you come over here, mortgage rates are sitting at 6.8, 7.5% for 15-year and 30-year. And these are levels that we haven't quite seen since 2000, basically. Actually, we're going back even further. We're going back as far as 2000. Yes. So mortgage rates for the 30-year has not got up to 7.5% in over 23 years, right? So in over 2 decades, we haven't seen these levels. So obviously, it is very, very rational for homeowners to continue to finance it at 2, 3, 4% and keep it locked in at that rate, because if they sell, they'll have to use that cash or proceeds to buy something in this market at 7, 8%. So that doesn't make any sense for them. And homeowners and basically buyers, for example, are not willing to pay that 7, 8% mortgage rate and aren't even qualifying for that. So roughly 92% of US homeowners have mortgages that have a rate of below 6%. Right? 92%. And that's that's exactly what we talked about in our live stream as well. That's the most rational thing you do, right? When rates come down, you refinance and lock yourself in at a lower rate. And over 92% of US homeowners have mortgages at under 6%. That's crazy, right? And as the 30-year mortgage rate is closer to 8%, homeowners find little interest in selling their home since they may have to buy another with a higher interest rate. And on the flip side, buyers are also contending with mortgage rates at the highest level in 23 years, as I just mentioned, since 2000s, and are dealing with low inventory due to homeowners not selling. And inventory of homes for sale shrank by 4% in September as compared to the same time last year. So what's really happening is sellers aren't willing to budge. Obviously, they're too stubborn and keeping prices higher, and they don't want to lower the price because they're locked in at a really low rate. And potential buyers obviously don't want to increase their bids because they're paying 7, 8%, right? That's already a crazy number to finance a home. Fannie Mae expects mortgage rates to stay in the 7% range through most of 2024 before ending next year at 6.7%. And they mentioned, I quote, "We expect the higher mortgage rate environment to continue to dampen housing activity and further complicate housing affordability into 2024. Now, this right here is the median sale price of a home in the US. And you can see that we have come from 1980s, from about 43 years ago, under $64,000, to now sitting at $430,000, right? So that increase is about 8x if you do the math. 430 divided by 63. It's actually a little bit under 7x increase in the last 43 years for home prices. This number actually capped out at 480,000. So this right here is the chart, and really where we capped out was 480,000 before pulling back all the way down to 419, 420, and then now we're back seeing a little bit of an uptick in the third quarter at 430,000. But the bottom line is, I mean, this is the overall chart of that consistent increase, of course, with a few recessions here in the 1990s. We've got this right here, the Great Financial Crash. Dropped from 225, 250s all the way down to low 200s. And then, of course, since then, we have just been on this consistent increase. And this is the substantial amount of parabolic move in home prices in 2020, 2021, all thanks to quantitative easing, lower interest rate environment, and prices have just absolutely gone crazy in the US. They have pulled back a little bit. So, they've gone from 479, 480 down to 430. So we have seen reasonable pullback, but nothing compared to this entire move to the upside thanks to quantitative easing. Now, one of the very, very important metrics to look at for home affordability is this home price to median household income, right? So home prices, as we already went over, now you also divide that by the median household income in the US. Now, incomes have not gone up by 7x, right? Even though home prices have gone up by 7x, almost 7x since 1980s, there's no way income has increased that much. And as a result, this ratio is at its highest level since 1955. So if you go basically across, which is a very unfortunate thing, if you go across to where we are at 7.4, this number doesn't even come close to any time in history since 1950s. And this is actually higher than where we were back in the housing bubble. What that means is that prices have gone up substantially faster than incomes have on a median basis. And as a result, this ratio is sitting at 7.4. So we are now higher and more sort of overvalued, you could say, right? This is a very equivalent metric to price to earnings or price to sales that we look at for individual stocks, that we are considered to be overvalued at 7.4. Now, there's one more chart that is home price to personal average income. Now, I like to take the median income because that is, the middle value, right? So there's obviously incomes above, there's incomes below, but average will make the data look a little bit better, only because it gets skewed because majority of the population is, obviously 1% of the wealthiest are making up majority of that income, right? So that data gets a little bit skewed because we're taking averages, right? So the higher the values are going to skew the data, kind of suggesting that incomes are actually much higher, but in reality, the median is what I like to focus on because it's giving you the middle value for income ratio, right, for that income. But this right here, even then, it's sitting at over 8. That's the ratio right now, and it's very comparable to what we have seen before from a great financial crisis perspective. So this is where we currently are. At just over 8. We have come down a little bit, but if you go back, we are going back to the same level from back in 1980s, and we are a little bit lower from the great financial crash of 2007, 2008. But this is again is taking into account the average income, which is skewed a little bit as opposed to median income. Now, this right here is the new one-family homes for sale in the U.S., and inventory is once again at its highest level, one of the highest levels that we've seen for inventory, and those are homes that are kind of staying on the market, 436,000 homes. This again is one of the highest inventory levels, of course, since the great financial crash. And then before that, we have to go back to 1970s and 1980s. Both times, of course, a recession followed. You can see the gray shaded areas where the recession eventually came, once there was a lot of inventory in the market. Both times over here, this of course was the great financial crisis, and every time there is an uptick in inventory, significant amount, right? There's not a lot of, except for 1996, 1997. So this right here was the only time that we didn't quite see a recession with a drop in inventory levels, but every single time preceding that, we have seen one. So this is where we are in terms of the overall housing market. And this is another indicator that suggested home purchases are falling through the highest rate in almost a year. And what this shows us is the buyers basically getting cold feet and not following through on their contracts, right? So they're basically getting out of their contracts on their pending home sales, and they don't want to buy anymore. And that's all thanks to higher interest rates. If they stay at 7, 8, 9%, well, guess what? It's going to become increasingly more difficult for buyers to continue to go forward with their buying of a home, because not only are prices high, interest rates are higher too, right? So it's actually the worst possible time, in my opinion at least, to be looking at buying homes, unless of course it's an absolute necessity for you and something that you can or have the money to finance, and then you can refinance later on at a lower interest rate. But considering how high the prices are, how elevated they are, and the home price to income ratio is at its highest levels, one of the highest levels, and not to mention interest rates are at 7-8%. It's a very, very tough time for home buyers, and I think the sellers will start caving, right? The sellers, the equilibrium is going to start getting achieved because, look, in any market, there's going to be liquidity issues if the buyers and sellers are way far apart. There's a massive spread, right? We talk about it in the stock market all the time, right? The reason why stocks are more liquid and more tradable is because the buyers and sellers are, very, very close to each other. There's going to be spreads for a few dollars, few cents, depending on the stock that you're analyzing. But with this real estate market, the spreads are super wide, right? They're already working with wide spreads because bid and asks are almost never going to be the same. Now, we've had a market where the bids have always overshot the asking price because of lower interest rates. This was back in 2020 and 2021. But now we are starting to widen that gap once again. That spread is widening because of higher interest rates. And someone has to cave, right? The buyer or the seller has to cave. It's either the buyer or the seller. And if rents continue to go higher, right, if they keep increasing, then the buyer potentially could be forced into, let's say, buying a home because it doesn't make any sense to be paying higher rents when the mortgage rate, even at 7 to 8%, is lower than what they're paying for rent. So that's one possibility. Or the seller starts to cave by lowering the price. And the only way that's going to happen is if the entire market starts to come down. If all the prices start coming down, and that's 1, 2, 3, 4, 5 sellers start to panic, and they're like, okay, I need to get out of this market or I need to sell before prices absolutely collapse. And that's what creates this entire sort of domino effect where a lot of sellers, a lot of inventory kind of hits the market and prices start really coming down. Then even at 7 to 8% interest rate, buyers can finance those homes. So that's where we are. Let me know your thoughts down in the comment section below. But this is, again, a very, very wide spread of buyers and sellers not being able to meet at an equilibrium of prices. But that's where we are. So I hope you guys enjoyed this real estate update. As always, if you make sure that you drop a like, subscribe to the channel, and link to our Discord and Patreon is going to be down below. As always, happy investing. I'll see you all in the next video.